Hey everyone, welcome to my channel and welcome back to my subscribers. This is Bald Guy Money. I am Bald Guy, and today we are talking about the Federal Reserve, quantitative tightening, interest rates, and what this all means with respect to hard assets, and whether this new talk about responsibility with respect to fiscal and monetary policy is actually going to make a difference to the markets beyond what we've seen already. This video will be a deep dive into the market and is absolutely crucial to watch if you hold precious metals, if you are interested in or are concerned about the real estate market, or if you are concerned about your 401k or other retirement investments. Because once I've finished explaining what exactly is happening, I will be showing a chart like this to show my recession outlook on these four assets, so silver, gold, real estate, and 401ks or stock investing, and whether I am buying, selling, or waiting for more developments. So be sure please to watch this video to the very end because it is jam-packed with important information that will help you understand the actual situation in plain terms, as well as mathematical analysis showing the reality of our situation. And just a warning to everybody out there, it's very shocking. As always, this is not advice, and if you could take a moment right now to hit the like button in support of my channel and in support of this content, it will help to continue to grow this amazingly supportive community. And if you need any other reason, it's my birthday today. So, if you're looking for another reason to hit the like button, maybe that's a good enough reason in itself. So we start off today with Janet Yellen. And for those of you not familiar with her, she used to head up the Federal Reserve and is now the Treasury Secretary for the United States of America. In her current role, she is the principal, the #1 advisor to the President of the United States on all things associated with economic and government spending policies, also known as fiscal policy. And despite this woman's impressive resume and experience, she said this a couple days ago, basically admitting that her thesis on inflation being transitory, or in simpler terms, a temporary issue, was absolutely wrong. And putting aside my personal feelings towards her and her associates at the Federal Reserve, it's amazing that such a well-educated person could have missed this, especially considering the fact that a lowly bald guy was inspired to create a YouTube channel last year to sound off on this topic. So there it is, I told you so. And now, as a result of massive inflation, the current head of the Federal Reserve, Jerome Powell, has declared war on inflation. And as a result, we are seeing interest rate increases, which for my international viewers are being copied by other governments around the world. And equally as important as the interest rate hikes in this war is what is covered in the headline of this article, which is the fact that the Federal Reserve will start to reduce the size of its $8.9 trillion balance sheet seen here. And this balance sheet has actually increased in size by 10 times since 2007. And it has flooded the market with money because, in the simplest terms possible, and I want you all to understand this number represents different forms of money the Federal Reserve has created and let loose in the market. And if we look at the next chart, you can see how that breaks down more or less, with currency in circulation shown in blue, deposits in banks for them to lend out to borrowers shown in orange, and a treasury balance which represents the purchase of treasury bonds or government debt from commercial banks in green. And this is often referred to as reverse repos. So if you've heard that term before, this is what people are talking about. And just to note to those adding up the numbers, this chart is showing selected liabilities only. As it stands today, the total Fed deposits, or orange line, are actually at $4.6 trillion. The treasury balance, so the green line, is a total closer to $2 trillion, with the currency number on the chart being the only correct one there. And this is where we can start to check whether the Fed's plan will significantly impact the market and exactly how much of the nearly $5 trillion they have created since 2020 will actually disappear from the market, and whether or not it's enough to actually have a significant impact on inflation. And we can do that because they have made their plans known. And to the regular person, I am sure that the plans the Fed has been talking about in the news sound extremely ambitious, because this is what they have committed to. And by the way, I have done a lot of research following Jerome Powell's statements. These numbers weren't actually all in one place or in one interview, so please feel free to add to the discussion in the comments section on these numbers if you have any questions or comments on them. But in a nutshell, the Fed will sell $95 billion in assets, which is fancy talk for they will start to take the money they created off of the market, and they will do that each month from June, so this month, till the end of 2024. And that's a total of 31 months, resulting in a total removal of $2.945 trillion from the market. And this is really rattling the markets in general, as we've seen the stock market, which is usually a leading indicator, sell off in dramatic fashion since the beginning of the year. Silver is marginally down since the beginning of the year, and we've covered the reasons why back in my silver price to go up video from May 14th. And now there are whispers of a correction in the housing market due to the increasing cost of borrowing money. And unless you're heavily invested in energy stocks that are in oil or gas or other forms of energy, this gold is probably the only thing in your portfolio that's doing really well right now, because it is actually up 3% since the beginning of the year and outperforming all of the major market indexes out there, except for, of course, energy, as I've just said. And as a result of this shakeup, and I know a lot of my viewers who are holding stacks of precious metals, as well as those who own their homes or are looking to buy a home, or who have 401ks, these people, you people, my viewers, are very concerned, and it's important that we quantify what the impact will be. So I have put this chart together to show you exactly how much money the Fed intends to take off of the market. And as you can see, it is 1/3 of their total balance sheet. Now, if we isolate this figure and look at only this figure, it seems pretty horrific. It can look like a lot, but just take a look at the figures below. There you can see the $5 trillion I mentioned before. That is the amount of money the Federal Reserve QE'd, so printed into existence since 2020, and they only intend on pulling 60% of that out of the market, which makes the 33% of their total balance sheet reduction seem a little less significant. And if we take a look at the total M2 money supply, which is a great indication of exactly how much money is really sloshing around in the market, if we account for the nearly $3 trillion the Fed plans to take out, it actually seems like a small sum, considering that isolated, it would leave us well above pre-C19 levels. And you can see that denoted in the October 2020 red box at the $18.7 trillion mark. And this brings me to my point on QT, or quantitative tightening, which is the reduction of the money supply. The numbers we are talking about are not as significant as what the Fed, the Biden administration, and the mainstream media would have you believe. That, paired with the fact that the US government, and governments around the world for that matter, have so much debt which limits how much they can actually raise interest rates, I am sorry to say it, but I am not expecting inflation to go away anytime soon. The current levels of inflation are baked into the economy. The prices are not going to go down. So anybody expecting price deflation, I'm sorry to say, it's not going to happen. And for those of you who are on a fixed income, I'm really sorry to have to break this information to you. So I want to reveal to you all, and I wanted to use this video to show you exactly how I am viewing the asset market right now, covering the main assets that I know are most relevant to my viewers, so all of you at home. And again, if there are assets I have not covered in this video, let me know in the comments. I can make that happen for you. I can do a follow-up video where I analyze those assets. And just before I reveal the chart, I will be using the term DCA a lot. That means dollar cost averaging, and it's a term you should all be familiar with. It is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price or the commodity price or the price of whatever it is you're investing in. And that's what I'm talking about when I'm talking about DCA. And thank you, Charles Schwab, for the articulate definition. So here is the breakdown, and we're going to talk about them each individually, starting with gold. So my outlook for gold in 2022 is strong, meaning that I think the price is still going to go up. My reasoning behind that is, and if you saw my February 14th video on gold, you'll recognize this, but this is it. In that video, I said that money was going to be pulled out of riskier, more speculative assets, and we've seen that so far. And it will be put in to safer assets like gold. I estimated that amount to be around $18 trillion. Details on that are in the video, but I gave 3 different scenarios on how much of that $18 trillion I expected gold could capture. And that broke down in levels of 5%, 10%, and 15%, giving us corresponding price targets for gold. You see that on the right side of the graphic, and they ranged from $2,020 per ounce all the way up to $2,353 per troy ounce. And that actually came true in March as we got up close to the $2,050 per troy ounce mark before coming back down. But I do expect a retest of those higher levels sometime this year. So coming back to my table, my personal strategy is to hold what I have right now, but DCA in less aggressively, considering the fact that we are on the upswing, and I never DCA too aggressively into things that are moving upward in price. That's just my rule, that's a rule of thumb for me. So I will DCA less aggressively this year than I did in 2021, and I will likely only add 1 or 2 ounces to my stack from today, till the end of the year. Now, when it comes to silver, I also covered this in a recent video, and my outlook remains unchanged. As a reminder, here's the timeline I put together where I said we will likely start to see significant price moves to the upside on silver around Q2 next year, with a price ranging between $39.50 per ounce up to $52 per troy ounce by Q1 2024. Now, I know some of you have sentiments that it will go higher. I sincerely hope it does, but this is what the numbers are telling me. So please don't be too cruel in the comments when you want to tell me that silver is going higher. Please understand that this is what the numbers are telling me. And if you want to argue with me, please argue with the numbers, not with me personally. I'm not a bad guy. I promise you that. Moving on to real estate, and this is an important message for those of you who own your homes. Maybe you have been considering lately of downsizing your house, moving into a smaller place and keeping some of the leftover money to live off of. Let me say that if you're not making that deal to downsize right now, to sell your house right now, I would personally wait. It's not advice, but I offer this up as a way of supporting what I'm saying. Interest rates on mortgages are on the rise. This graphic was taken from the Washington Post, an article that I found online, which I'll link up actually in the video description, and you can take a look at it yourselves. But it basically shows exactly how much mortgage rates have risen versus last year and earlier this year. And for those of you wondering how this actually impacts how much people are paying to the bank for their monthly mortgage payment, I can say this. While researching for this video, I found that average mortgage payments have already increased more than 40%. In one example I found, a person who had been paying $1,300 a month for their mortgage is now paying $1,900 a month for the exact same property, for the exact same mortgage. Now, as a result of persistently high home prices, as well as increasing costs associated with borrowing money to buy a home, so those higher interest rates on mortgages, we are starting to see people drop out of the market, as highlighted in this article from Forbes. So my message to my viewers is I would personally wait. Again, it's not advice. I'm just saying what I would do and actually what I'm doing right now. Because this is going to start turning around as soon as Q3 this year. Now, many of you know that I am an investor in real estate, residential rental units to be exact. And if you're like me, this is a moment where you'll be able to exercise your ability to increase rental prices. With people's ability to borrow money getting more difficult and the cost of borrowing that money becoming more expensive, demand for rentals will undoubtedly increase as the demand for actually purchasing homes decreases. And if you're renting a place right now, this is kind of what I would do if I was in your shoes. I would say now is the time to start seriously saving up for a down payment on buying my own house. And if the reason for that is because once the prices come down, that's going to be a fantastic moment for you to pounce on the market and take advantage of the lower prices once they start to correct. And that is why I am doing this with my own personal real estate strategy. So I am holding on to my real estate, the ones that I own right now. I'm not looking to sell anything. I'm not looking to buy anything new at the moment, but I am waiting for the correction before I buy my next property. And remember this, owning real estate is true freedom. Real estate is 2/3 of my personal portfolio, and if it's not on your radar and you're watching this video right now, owning real estate absolutely should be, because it is the hardest asset in existence. Now to the last topic, and we are talking stocks and 401ks, because I know a lot of my viewers have these, and if you are nearing retirement and are worried about the value of your portfolio, it's crucial. It's absolutely crucial that you watch this part. Because I first mentioned this back on October 5th, and the video is there if you want to go back and watch it. And sadly, the video did not get many views, but in that video, I showed this. And I said that the valuations of companies compared to their earnings was way out of control. It was too high. And I showed that using a very simple analysis of historic PE ratios. And the PE ratio, just in case you're not familiar with that term, is the price of the stock or the company versus the actual earnings of the company. And what I said was that we are clearly in a bubble. Now, I also said that the bubble we were in at the end of last year wasn't as big as the dot-com bubble or the financial crisis bubble we experienced when the housing market crashed in 2009, 2010. And you can see where we were with respect to the stock market before those crashes here and here, compared to when I made the video back in October 2021. And what I specifically said is that I expect a 25% pullback in the market as a whole to correct for the crazy valuations that were a direct result of easy money coming from the Federal Reserve. And as it stands today, I stick by that number. So if you're holding stocks or you have a 401k, this is what I think you should probably be looking forward to, or at least preparing for, in the near future. Let's take a look at it. So if we take a look at the Dow Jones Industrial Average, which I think is the best way to benchmark this, as it stands today, we are down about 9% from all-time highs, which we touched in November of last year. In comparison, the S&P 500 is down about 15%, So if I was holding a diversified retirement instrument like a 401k, I would still prepare for the value of that 401k to drop another 17% from here. That would be my high-end target of the drop before we start to see a recovery. Now, does that mean panic and sell everything? For those of you who are very close to retirement or are already retired, I would say compare the value of your portfolio today versus where you were back in, let's call it early 2020 or late 2019. If you're still in the green over that period of time, and many of you should be in the green, you might want to consider taking a little bit of that money, if you're able to withdraw a little bit of that money at no cost to, or penalty to yourself. You might want to consider taking out a little bit of that money. Again, totally your choice, but it may help you sleep better at night, and keep it somewhere on the side just in case another opportunity comes up, or save it up for a rainy day. But if you're like me and you still have a long way to go before you retire, well, I can't tell you what to do, but this is what I'm doing. I am actually increasing my DCA as we fall, because the way I see it, it's moments like this where real money is there to be made. And I will even go one step further in this video and tell you exactly what it is I am DCAing into. Here's the list. You can see Google, Facebook, which has changed its name to Meta, and I know a lot of you out there don't like this company, and for very good reason, but the fact is that there is a lot of value there. So much value that even Michael Burry, who was featured, kind of made famous in that movie The Big Short, if you've seen it, the guy who shorted the housing market, he is actually buying Facebook Meta stock right now. So if you like money but hate Facebook, I suppose you need to choose what's more important to you. I also have some Invitae, which is really priced low right now. It is a biotech company that specializes in genomic health, and they could be an important player in the health industry in the future, and that is why I've decided to start DCAing into it. And if you're curious about that, I highly suggest researching the company. And I am also DCAing into Amazon and Baba, so Alibaba still, because these companies both have great fundamentals and are diversifying their income streams. And the stock prices have plunged recently, so that's what I am personally doing. And on the topic of Amazon, I actually only started DCAing into Amazon. I bought one full share at $2,200, just for full disclosure, to let you know what I'm doing and how I'm doing it. Ladies and gentlemen, if you have made it this far, I thank you. I thank you. I wanted to give you a full update on what I'm doing and how I see things. It's not all doom and gloom from my point of view. We have been in worse situations. If you remember back from 2008 to 2010, I believe the stock market actually took a 40% haircut. I don't expect that kind of crash to be happening now, but we still have a little ways to go down before we start going back up again. And again, if you're holding cash, inflation is here to stay, and you need to prepare yourself for an environment where inflation is going to continue to happen. And that said, that's again why I started the channel, converting cash into assets, into things like silver, into things like gold, investing in real estate, owning some good companies, not a lot of good companies, but some good companies, owning Bitcoin, which I didn't cover in this video, but I can cover it if you request it. Please drop me a comment and let me know what you thought of this video. Give me feedback to let me know if you want more long format content like this, explaining in detail what I'm doing and why I'm doing it. And if you haven't dropped a like yet, remember, hey, it's my birthday. Drop me a like, please. As always, I wish you all the best. I wish you all health. I wish you all happiness. See you in the next one. Bye.